In 2019, WeWork was one of the most valuable startups in the world, reaching an astonishing valuation of $47 billion. Investors believed the company would completely transform the future of work. Offices were opening across major cities, billions of dollars were flowing into the business, and everything seemed perfect from the outside. To many people, WeWork looked like the next revolutionary technology company. But behind the headlines, behind the impressive offices and billion-dollar investments, a completely different story was quietly unfolding. Investors were fascinated by the company's vision. They believed flexible workspaces represented the future of business, and billions of dollars poured into WeWork through multiple funding rounds. Every new investment pushed its valuation higher than before. The media celebrated its rapid growth. Entrepreneurs admired its ambitious mission, and many people started comparing WeWork to the biggest technology companies on the planet. WeWork was founded in 2010 with a surprisingly simple idea. Instead of forcing companies to rent entire office buildings, it offered flexible workspaces that businesses could use whenever they needed them. Beautiful interiors, premium facilities, and a strong sense of community made these offices incredibly attractive. Startups, freelancers, and even large companies quickly embraced the concept, helping WeWork expand into major cities around the world at an extraordinary pace. But behind the impressive offices and billion-dollar valuation, serious problems were beginning to appear. WeWork spent enormous amounts of money opening new locations while signing expensive, long-term leases. At the same time, it rented those offices through much shorter agreements. Revenue continued growing, but expenses increased even faster, leaving the company dependent on constant investor funding to survive. Everything changed when WeWork prepared for its initial public offering. For the first time, investors carefully examined the company's financial reports and business structure. They discovered massive losses, questionable decisions, and a business model that depended heavily on continuous investment. Confidence disappeared almost overnight, and what once looked like an unstoppable success story suddenly became one of the biggest corporate failures in startup history. One of the biggest reasons behind WeWork's success was perfect timing. Startups were growing rapidly, remote work was becoming more common, and businesses wanted flexible office spaces instead of long-term leases. Investors believed this trend would continue for decades. That belief, combined with aggressive expansion and impressive marketing, convinced many people that WeWork was building the future of work rather than simply renting office space. Within weeks, WeWork's valuation collapsed dramatically, destroying billions of dollars in value. The company that once promised to redefine the future of work became a powerful reminder that rapid growth alone is never enough. Great marketing can attract attention, and huge investments can accelerate expansion, but only a sustainable business model can build a company that survives for the long term. The story of WeWork teaches one of the most important lessons in modern business. Rapid growth can attract headlines, billion-dollar investments, and worldwide attention, but none of those guarantees long-term success. A company must eventually generate sustainable profits and build a business model that works even when investor money disappears. That is exactly where WeWork struggled, and why its rise and fall continues to be studied by entrepreneurs and investors around the world.